The next stock screening metric I want to talk to you about is the price to earnings ratio. The price earnings ratio, or PE ratio, is one of the most widely used and often misused metrics of a stock screen. The PE ratio is calculated by taking the share price and dividing it by the earnings per share, EPS. The PE ratio is essentially a measure of how much investors are willing to pay for each dollar of a company's earnings. A high PE suggests a stock could be expensive. A low PE suggests that a stock could be cheap. Now that you know how to find the PE ratio, you need to know how to interpret it. And the important thing to note here is that the PE ratio can vary by industry. When using the PE ratio to compare one company with another, make sure you are comparing companies within the same industry. You can even go a step further and compare a company to the industry's average. Because the PE ratio is subject to many variables, it should be used as a guideline with other metrics. You can't pinpoint the exact value of a company by this metric alone. There are many different ways to interpret what a company's PE ratio means. For example, a lower PE ratio could mean that a stock is undervalued. But it can also mean that investors believe the company's earnings are set to decline. Just because a stock is cheap doesn't mean it can't get cheaper. Conversely, stocks that have a higher PE ratio are thought to be overvalued. As you can see, using the metric won't give you a concrete value of a specific stock, but it can be a starting point to narrow down your research. Remember, because of all the variables that can affect the PE ratio, this metric should not be used alone. And that brings me to my next metric.